Per usual, living on this channel is for educational purposes only and is not intended as financial advice. It is Monday. Let's take a look at some Bitcoin charts first, then we'll get to the macro side. And we had quite the flush in funding this morning. Happened around 2 a.m. EST. And then on US Open, we had another little flush, potentially bond related, potentially rate expectation related, potentially Middle East related. Lots of potential reasons. What was encouraging to me is that we did not see a lot of volume on the down move. Even here, you can still see a declining volume profile. Typically, when you see that, there's almost always a chart pattern evident in price. I don't know a specific chart pattern that's going to embody everything from 60 to 70 here. It just looks like massive mega chop to me at the moment. But we have survived so far on the 12-hour fractal stop losses. We will barely survive by the looks of it. Around 4 hours left on this current candle, but certainly a hairy situation for those of us on leverage, seeing price just plummet as quickly as it did. On the funding side, funding, like I mentioned last night, was screaming kind of for no reason, right? We weren't going anywhere. We were just flat. You'd think with funding like it was, we would be pushing highs, but we weren't. Like I said last night, there's a bit of a time component there. Either we got to do something quick or people start to close their positions, people start to get liquidated, that sort of thing. Market chose the latter, and we seem to be trying to heal whatever went on last night. On the OI side, I know a lot of people, open interest, are concerned about this, i.e. they assume we need to flush all of this open interest. This is just crypto. This is not legacy, CME, TradFi, open interest. So I think there's this assumption because we are at all-time highs in OI, we have to flush this. I'm not really in that camp. I think it makes sense. I think it's fine. I don't know how you push all-time highs without all-time highs in OI. You kind of need that. Now, this does say there's a lot of leverage in the system. Would I rather this leverage be on the spot side? Sure. But I'll bet if we compared this to ETF OI, effectively, ETF AUM relative to crypto OI, it wouldn't be that big of a deal. I mean, considering we had 0 ETFs back here, we've got between 10 and 12 billion in ETFs now. So I'm not super concerned personally, but yes, OI is screaming across the board. As far as the flows are concerned, we did have, I think it was around 800 million on the inflows last week globally. Nice little reversal from the week prior. And on the individual asset side, again, Solana +6, Ethereum -19. So there's your Sol ETH pair playing out with the institutional crowd. Most of this money coming into the United States, coming out of virtually every other country because our products are cheaper. So if you have access to our products, which most people globally don't, but if you do, it just makes more sense for most people because of the fees. We also had a little bit come out of short Bitcoin, and a decent slug come into other, which is probably an index either in CoinShares or 21 Shares or any of the European ETP issuers that have to dig into that. But for the most part, it's an all Bitcoin flow show. Before we go any further here, let me mention today's video sponsor, Kraken Pro. Kraken Pro is a complete overhaul of the Kraken trading experience with a one-stop shop for advanced and professional traders. Kraken Pro enables efficient trading execution across multiple markets with a UI that allows for unique optimization tailored to your trading style. You can check out Kraken Pro with the link in the description of this video. Not investment advice. Crypto trading involves risk of loss. Cryptocurrency services are provided to U.S. and U.S. territory customers by Payward Ventures, Inc., PVI, DBA, Kraken. So I've mentioned this before, but there is a gold stablecoin, PAXG, available for trading on Kraken. I know there's a certain segment of the crypto population who sees gold as an investable asset, and it's always nice to be able to trade everything in a one-stop shop without moving stuff around. And gold certainly has this inverted head and shoulders breakout. It has a multi-decade, I think, cup and handle breakout. Gold should continue to do well. Signals issues with debt, signals issues with fiat currencies in this push to hard sound money. It's super bullish for Bitcoin, and it only enhances our narrative on the digital asset side. Two other charts that I'll just keep mentioning, Maker BTC, something to watch, and Ocean I've talked about before. The same type of deal, right? I just like that these charts collectively, I mean, PAX-G is no different, right? It's multi-year consolidation at highs or about to break highs. So it might take another 6 months. I don't know, but nice little chart to watch other than the usual crypto USD pairs. You know, there's a lot of stuff on here that isn't just BTC USD, for example, right? There's a lot of other different things you can trade and find and look around, stuff that I don't really talk about often, but very interesting pairs all over the place. As far as the legacy schedule this week, to me, the only thing that matters is employment stuff. We've got ADP Wednesday and unemployment NFP on Friday. There are 55,000 Fed speakers all week. Again, what do these people do besides go on the speaking circuit? Jay Powell on Wednesday. I mean, I guess the alternative here is we just don't know at any point what they're thinking, but any one of these people can have market moving statements about rates. So it's kind of dizzying to think about who's going to say what and where and what that means for the market. But if you're a Fed speak watcher, you've got a fun week ahead for yourself based on the number of speakers. As far as rates currently, next meeting is a month from now. Not expecting a rate hike. It would be, or a cut rather, it would be holding once again. Month after that, there is an expectation, it's almost a coin flip, that we will start the cutting cycle. If not June, then July. And if neither of those, then we get into the election season. And they're probably not going to cut in November, I'd imagine. But I guess we'll see, right? Depending on the data. Now we're starting to see the unemployment data tick up a little bit across the country. That may change their mind. Per Powell, the inflation data is maybe not what they'd want to see ideally, but it's not alarming. So maybe that's enough for them to start cutting rates a little bit. Based on market prices, based on grocery prices, I think most of us would agree that we don't really need a cut. The market thinks it wants a cut, and the government certainly wants a cut because most of our debt is in the short term and quite high. And it's going to be very expensive to refinance that on the long end if rates are where they are. So a lot of interesting game theory stuff going on. And of course, the people that are paying the most for rates currently are those at the very bottom who have credit cards. And like student loans, I just assume most of these high interest rate credit cards just don't get paid off. I know a lot of them do get paid off eventually, but this is just a crippling amount of interest to be paid if you've got a maxed out credit card right now. What chance do you realistically have at paying this off? I think slim to none for most people who are utilizing that credit card. Everything on the macro side sort of talks to itself. Rates, treasuries, bonds, the Fed, DXY. It's all relative, right? So even though we are fairly dovish relative to where we were a year ago, meaning we favor looser monetary policy, or we're getting there, we certainly have been loose based on the data, but based on what the Fed is saying, that hasn't been the case. So even though we are dovish on this side of the world, much of the world is already and has been cutting. So even though you think in our little bubble that, okay, unemployment's starting to rise, inflation's still a problem, maybe that's going to impact DXY because there's some yin and yang there between cutting and leaving rates where they are. Based on the rest of the world, we are still the best currency so far. That's not going to last forever, but it's probably going to last for most of our lifetimes at this point. So as awful as you think the dollar is, right? The DXY is telling you globally, we continue to strengthen because other currencies are weakening against the dollar. On the technicals, we've been talking about this kind of gross diamond bottom potential. And even the daily cloud now, we're getting a bullish Kumo twist, bullish TK cross. We had a failed inverted head and shoulders that kind of went nowhere, retraced. There's been a lot of talk of another type of accord per se to get the dollar to weaken in some fashion. You know, we'll see how much and how fast DXY rises. But I think this is another reason why today we, on the Bitcoin side, on the crypto side, got very angry because we are inversely correlated to the DXY most of the time. So even though we have a million different tailwinds for us, this is a pretty significant headwind. If, let's say, DXY breaks out to above 107, then many things could be in for a world of hurt. So it's just something to watch. and maybe not go 100x long, right? If DXY is at 108, that usually isn't going to help us. On the inverse of that, post halving, let's say 3 to 6 months from now, if DXY is sub 100, then it's probably alt season. It's probably Bitcoin above 100,000, above 150,000. Rates are down significantly. So it's just something to watch while we are chopping around on the Bitcoin side near all-time highs. DXY is kind of this gorilla in the room that we do not want to see continue to go higher. On the GDP side, on the estimate anyway, this has had another upswing. So it's going to be pretty hard to label this as a recession if GDP still positive, still very positive for Q1. Unemployment might be a different story, but GDP thus far looks fine. Truflation is reporting US inflation somewhere in the 2 to 2.25 range for the past, we'll say year to date. Their inputs are constantly changing depending on the data, so it's going to look slightly different from week to week. Their basket changes from time to time. So it's not a perfect analog, but it is a nice close guess as to where we're headed. Even though CPI is ticking up, truflation is still rather flat, rather unexciting at the moment. In the UK, very much the same, kind of flattened out here at over the 2% target, to be clear, but still down significantly over the past 12 months. Now, the question is, as many people have said, what about the last mile? Are we going to get to that 2%? Are we going to risk massive unemployment to get to 2%? Do we have embedded inflation above 2%? That hurts savers. That hurts the bottom of the ladder that doesn't have assets, that don't have wages keeping up with inflation, and that favors Bitcoin, it favors gold, it favors hard assets, it favors oil, favors equities, right? So if we can't keep inflation down globally, that would certainly help Bitcoin. But the question is, do we want that? Do we want global inflation to be out of control? I don't think that's a world we want to live in, personally. I think Bitcoin can do well without that. This is inflation in the G20. Argentina and Turkey just out of control. Russia up there significantly. UK and the US down here, 3.25 range. China on the opposite end of the spectrum, exporting deflation at this point. So globally, things have come down a lot for most countries. The question is, what do we do now, right? Do we keep going? Do we leave higher for longer? And I think that's a question for the central planners. Do they want to continue to squeeze businesses and interest rates and mortgage rates and credit card rates? Have they done as much as they can, I guess, is the question. And again, globally, stuff doesn't look pretty. Okay, this is just a random data point from France. So all this to me says globally, DXY should continue to do well because everybody else continues to look very poorly. Maybe as negative of opinion you have on the US dollar, things elsewhere are much worse. This is the Fed's nowcast for CPI, and not much change overall, maybe headed in the right direction, but it's obviously too early to tell what the April number is going to be. The next CPI print, I think, is on the 10th or something next week. So we may be flat or slightly up month over month on US CPI. PCE also in the near term was rising. So we haven't been able to keep PCE low enough for long enough, probably to satisfy the Fed. Realistically, they want to see this cruising at 2%, not double tapping in and then bouncing back to above 3%. Energy is not going to help this. Supply chain is not going to help this. Middle East, Russia, Ukraine is not going to help this. Onshoring, nearshoring is not going to help this. So it's probably going to continue to be challenging to bring CPI and PCE down. One thing that's going to help CPI is the shelter component, which if we look at, this is like the Truflation Index. They look at real-time data. Apartment list, Zillow, new tenant rent, OER is in there too. OER is in the CPI component, and the rest of the data is all the way down here. The rest of the data is flirting in the negative territory, whereas OER, which is 26% of the weight of CPI, is still quite elevated on a year-over-year basis, but it should continue to come down. So just as we're seeing the benefits from the energy slice year-over-year rise again, we're thankfully seeing the shelter piece come down. And this is gas in the United States. Continues to creep up here week over week, year to date. Hasn't really significantly held, I think, below 3.25. And this is definitely not going to help CPI. We're seeing that filter its way in the US oil chart, which, much like DXY, similar vibes where this could be a bottomy type pattern, bullish Kumo twists above the cloud, right? This is all trend stuff that we do not want to see if we are hoping inflation is under control. And even on the weekly, we're back in the weekly cloud. And you could argue at this point, maybe this is a W double bottom, right? Maybe this is a multi-month W double bottom. Previously, I had talked about this possibility, which very much looks to be negated with any weekly high up here at 85. And on top of that, XLE continues to look very, very bullish. The technicals look very, very bullish. This is the energy sector ETF. Trend looks great. Cloud looks great. Chart pattern looks great. And this will not help us on the inflation side either. Similar to DXY, in a portfolio for me, as an example, I have cash that's yielding. I have this ETF called USDU. I'm not going to explain it, but it's an interesting play on the DXY. I've got XLE for this very reason, almost as a hedge against the bullishness of Bitcoin, just in case there's a dynamic there that pulls crypto down or prevents crypto from continuing its ascent. As far as yields and liquidity, reverse repo continues to get drained. This is down to 441 billion, not a multi-month low, but pretty close. So the more debt issuance we have, the less likely this thing's going to hold its levels. Money markets are going to continue to buy that debt. They're going to move out of the reverse repo into short-term yields. And this is one of the reasons why the Fed's a little bit spooked about continuing QT at the pace that it currently has. And they've talked about the QT taper. We may hear more about that this week from the 55 Fed speakers. Yields on the short end in the orange here have come down a little bit over the past few months, probably around the lowest standard deviation, I guess you could say, relative to where it's been. The long end rising, the belly of the curve kind of flat. Yield curve still inverted, but I think this continues to signal the market thinks short-term yields probably coming down, is my guess. And they want to get paid more for the long end because of our debt issuance. Here's that inversion on the yield curve, and it went inverted, I think 2 years ago, April 1st. Doesn't look like it's headed anywhere fast. Unemployment here in the yellow. And the markets can certainly continue holding bullish until this flips, right? There are so many people who are still incredibly bearish with things at all-time highs. I just don't get it. I do not get it. If we look at unemployment across the United States, this is the breakdown looking at the SOM rule, which is basically the point of no return historically for unemployment in 20 states out of the 50, including DC, it's 51, but 20 out of the 51 have triggered the SOM rule, which would suggest recessionary type behaviors based on the unemployment data. So it's definitely something worth keeping an eye on. There's also this interesting point about excess retirees, especially post-COVID. There was a ton of people who just said, okay, I'm going to retire, right? If you're close or at retirement age. And we're continuing to see that, as some people have argued, because of the wealth effect. There's just less of a reason to want to work for somebody who has significant 401k or significant wealth. They'd rather just enjoy life. That's what a pandemic brings. It brings reality to a lot of people who maybe don't want to continue working and rather just live their life. There's two charts from the US debt issuance that have sort of made the rounds this week. This is the first one talking about most of our issuance in the short end. And this is where the reverse repo money is going. They did this on purpose. Yellen specifically did this on purpose because there was that excess in reverse repo to drain. And the question is now, what do we do, right? Do we go to the long end? Do we go to the medium end? What do we do? And the other chart making the rounds this week was this one talking about US Treasury payments. And this is, of course, absurd on its face. And how do we recover from this? Just as anybody, how do you recover from a 25% credit card that's maxed out? I agree. But as Keith points out here, we are the last one to worry about relative to the rest of the world. And if you compared globally what these treasury payments would look like, you'd continue to see problems, which is another reason why the DXY continues to look strong and move higher. Now on the US TLT long end, TLT got walloped today. And I guess if you are bullish, you're hoping this is a falling wedge, which it could certainly play out as on a technical basis. If TLT drops below 91, below the cloud on the daily, that's certainly a bearish argument. Okay. So I would read this probably somewhere in the middle. It almost looks like a descending triangle. Maybe we will know with cuts later in the year what this plays out as, but it's not something I'm willing to sit in and hope that this cracks bullish, because it certainly doesn't look like it wants to do that. And if we go to the weekly, it is denied on the weekly cloud, and it may get a bearish TK cross coming up here. And this thing has been down only for several years now. So the time may come to trade this to the long side, but that to me is very much not now. And one of the reasons for that, if we look at TNX, which is the 10-year yield, has continued to rise. So you have to remember bond yield down, bond price up, bond yield up, which is what this is happening now, bond price down. And this is going back since the 80s. We've clearly broken this descending channel. So the question is, where does it go now? Well, the 10-year to 8% would be insane, but that's the 50% retracement of the high to low. Certainly nothing anybody wants, but based on our debt issuance, I don't see how this doesn't keep creeping continuously higher until we get the debt under control. As far as the S&P is concerned, hasn't much mattered because this is the year to date on the hourly cloud. It's looked great. So as cautious as I may be, or as bearish as you may hear people, the trend looks great. The channel looks great. The cloud loves it. And until this at least is below the hourly cloud, okay, then we can start getting a little bit concerned. You know, we can go to the daily and say, as I have, this is overbought. Momentum is slowing down. There's a risk of a TKC clamp. There's a risk of an edge-to-edge move here. All that is very much true, but we need to see this slow down to some degree before we can even trigger that alarm bell. So this continues to look very good. Maybe next week this will be below the hourly cloud, but it looks fine, right? On low time frames, a nice orderly advance year to date. I mentioned Google last night, and Google continues to, as I have trouble saying that word, continues to push highs, hit an all-time high today. One of the better looking, if not the best looking, of the Mag 6 or Mag 7. Still looks like a significant upside there. On the flip side, Palantir, something that I know a lot of people have been trading and looking at on the lower time frames, has started to look a little toppy to me. It was previously, and still is really, in this megaphone, but that very much looks like a head and shoulders to me. And then the 6 charts that I'm sort of looking at and or trading, Hood, Square, PayPal, all look fine to me. TOST, another point of sale system, also looks very good to me. Zoom, not something I'm touching anytime super soon, but that's something to continue probably to look at in case there's ever a bounce here above 70. The difference between Zoom and Peloton, right? You know, these are like the Zcash and the EOS of legacy. Just zero recovery from the lows here. Very angry at the lows. Maybe you're hoping for a falling wedge on Peloton, and maybe these companies turn it around once we get cuts, but I wouldn't stick around to find out. These other fintech companies certainly look much better to me. Lastly, I'll just mention WGMI. You know, as bearish as I am in the miners across the board, and just for any industry, gold, uranium, silver, I'm just not a fan of the miners in general. One way to look at this trade on WGMI or any of the miners is to just say, well, if this breaks up, maybe your target is 30, okay? Maybe it's above that, but let's just say 30. If we take off the cloud and we just look at this consolidation, it's getting to the point where you could argue your risk reward is actually pretty favorable for just buying anything close to this diagonal support with a stop loss below the diagonal support or the previous horizontal. And we can go through the minor charts and look at these. CleanSpark probably the least likely because it's already moved so much, but you know, TeraWulf is another one that people have been looking at. It's kind of a similar setup where a lot of these are just consolidating for so long. As we reach and approach halving into post halving, it does feel binary for a lot of these miners, regardless of how well they may look on the numbers. So if you're convinced, you know, if you think Wolf is going to 6 or 7, right, then why not just load the boat up here and wait? You know, your stop loss could be $1.65, for example. So across the board, we look okay. We look fine. The debt stuff is getting scarier globally, certainly. More people are talking about it. And we may have an event where the Fed has to step in. And that would be another win for Bitcoin. So that's all for this one. Like, dislike, comment, share, subscribe. And happy trading.